Can everybody see that? Slightly bigger. Okay, great. Okay, so here we've spoken a little bit about this. Capital expenditure motives, replacement expansion, yeah, in order to achieve an accept or reject decision, right? Here we touched on this already. So specifically, we spoke about that it's based on incremental cash flow. So, and then we spoke here a little bit about sunk costs. Externalities, cannibalization, conventional versus unconventional. Remember, we had cash outflow, then cash inflow, cash inflow, cash inflow for your conventional. And then we had, for our unconventional, we had outflow, then inflow, outflow, inflow. So multiple changes in the signs. Has anybody done much in the way of capital budgeting? Anybody? So you used to work at Deloitte, right? Yes. So I saw you on one transaction, I think, right? Exactly, yeah. So didn't you get involved in the modeling there to an extent? So then you should see a lot of this, cash inflows and cash flows. And yourself, did you put your hand up? Oh, you didn't. Okay. Anybody else in capital budgeting? Okay, so we said that cash flows can be based on opportunity costs. So what is the next best alternative for the use of the asset? Timing of cash flows is important, and we spoke about after tax and finance costs. Okay. Independent versus mutually exclusive. So again, independent projects should have no. You can do A or you can do B. With mutually exclusive, you have to do A or B. Right? Project sequencing. Yeah, you can do project A. If that works out, then you can do project B, then you can do project C. And then unlimited funds and capital rationing. If you have unlimited funds, then anything with a positive net present value creates shareholder value, and you undertake that project. If you have capital rationing, then you need to rank the projects, right? You want to try and choose those projects that will maximize your net present value. So we're going to talk about that later this evening. Okay, any questions so far? That's just a quick recap. Blew through that fairly quickly. Everybody comfortable? Everybody loose? Okay, so let's start to talk about a few things that I found that with level 2, the exams started to ask a lot more around. You would have a theory, and then they would ask for the theory to be applied, such that they would say, you know, for in this instance, you know, depreciation. If depreciation is accelerated, what does that mean for your cash flows? So I think things like this are quite important. Trying to understand how it may impact to the extent you have to do an analytical an analysis. Okay, so important to note that the depreciation method used by a company to write off their assets when assessing a capital project. So here we're going to talk a little bit about most companies use straight line, but to the extent they want to try and accelerate that, they can help their cash flows. So specifically the modified accelerated cost recovery system, all it does is it effectively front loads a lot of the depreciation. So it has, instead of a straight line method of, say, if you're going to depreciate it over 10 years, you would just do 10% a year. The accelerated cost recovery system effectively helps you depreciate in a different manner to the straight line method, and effectively uses a system of assets with a more or less arbitrary prescribed life, called a recovery period or class life. Okay, so here we can just see a few of the instances: 3 years, certain manufacturing tools, 39-year things like commercial property or industrial buildings. So you can see just on the next page. I'll just give you a quick example. Oh, sorry. They tell you what your recovery allowance percentages are for example, for selected investment properties. So you can see class of investment, 3-year, 5-year, and how you would effectively front load the depreciation. So the asset will be substantially depreciated in the first half of its life. Under the MACAS system, it is assumed that an asset is placed in service during the during the middle of the first year, the effect will be that the half-year convention is to extend the recovery period by more than 1 year in order to ensure that the asset is fully depreciated. Okay, so I think if we just look at the example, you can see here, they consider a motor vehicle purchase for 50,000. It has a life of 5 years. Depreciable basis is 50,000, and they just depreciated 20% in the first year, and then 32, 19, 12, 11, and 6. And so all they're looking to do is to try and take a larger write-off and then effectively help their cash flow. So they essentially, because timing is so important when it comes to net present value, you want to try and generate as much cash flow in as early as possible. So I think that's all they're looking to do. So to generate a cost saving or tax saving. Okay. So obviously the depreciation expense would be 50,000 over the 6-year period. Okay, so I don't think it's too complicated. I think all they're looking to do is to say, look, there is this accelerated depreciation method out there. There are arbitrary rates at which you would depreciate. You are looking to front load your depreciation such that you can get cash flows earlier in the cycle and you can generate a higher net present value. Okay, so I think that's all they're looking to say. Okay, so let's look at this. So we're going to talk about expansion and replacement capital projects. So we're going to talk about a little bit about, I think in the first instance, we talk about expansion projects. And then when we talk about a replacement project, we're going to talk about the incremental cash flows of having one project go out of, or one machine go out of service and then one machine coming into service. Okay, so the way that we're going to do this is we're going to just look at a few of the definitions and the formulas first, and then we're going to do an example together. Okay, so in the first instance, we are talking about an initial investment outlay, right? So in our little example that we did, question 1, we had an initial fixed cost that was paid for the equipment or the machinery, and then we also had an increase in our working capital. So they said that our inventory, or was it inventory? I think had to increase by a certain amount. Okay. So we would have increase in fixed capital, and we would have an increase in net working capital. And obviously, net working capital is defined as current assets minus current liabilities. Okay, everybody fine with that? Good. Then we would have cash flows over the life of the specific project. So we would have our operating cash flows over the life. So you can see essentially what they do is they work out the sales minus the operating costs or operating expenses, 1 minus the tax rate, plus potential or the tax saving on the depreciation, right? So these would be the annual cash flows. So there's our sales minus our operating costs. And we would need to multiply that by 1 minus the tax rate. And then we need to add back, because we're going to have a tax saving due to the depreciation, the tax rate multiplied by our depreciation charge. Everybody okay with that? Huh? Annual cash flows that are coming in from a specific project. So, any questions? Okay, so we've talked about the beginning of the project. We've spoken about a project that's got annual cash flows. And then we're going to talk about at the end of the project. Okay, so then we're going to have now our terminal cash flows at the end of the project. So generated at the end of the project's useful life. Okay, so we're going to probably sell the piece of equipment, so we're going to get some money from that. We also can unwind the inventory or the ramp up in the net working capital, so we're going to get that coming back at us in terms of the cash flow. And then to the extent we have a profit or a loss, we're going to either have a tax payable on the profit, or if we have a loss, we're going to have a tax saving on the loss. So we can break it down into those 3 elements. Okay, so there's the sale price that we would get from selling the the machine, we would have the net working capital coming back at us, so the investment in net working capital, and then this would obviously be the tax, either the tax burden or the tax saving that we would incur. Okay. So, and then we're going to use this cash flow to calculate an NPV and an IRR for the project in order to determine whether we should accept or reject. Okay. Mm. Yeah, well, I mean, yeah, but I assume if you're depreciating an asset to zero, I assume it's worth zero. So I assume you would just be, yeah, you'd be discarding it at that point, right? But if you do sell it for a profit or sell it for a value that's above book value, yes, you will incur a profit, and then you'll have to pay tax on that profit. Okay. Okay, so determine NPV analysis, whether a project should be undertaken. Let's see here. So, okay, so this is the example that we're going to go into. So we're going to speak first about the expansion project. It's quite a long example, and then we're going to talk about the replacement. So I think once you've got the expansion project down, I think then we can just kind of touch on points in the replacement. Otherwise we're going to be here all night. So, okay, so expansion project, firm purchases new assets. The new assets is intended to increase the company's sales. Okay, so a little bit of the information that they give us. So the company needs to purchase a new building. So there's going to be a cost of the property, 15,000, and then the cost of the equipment is 7,000. Okay, the building will be built and the equipment installed in year 0. The production will commence in year 1. So they'll start generating sales in year 1. Sorry. The new product or item that will be manufactured requires an initial working capital increase of 5,500. So we know that's going to be part of our initial capital outlay. It'll run for a 4-year period. At the end of the project, the building will be sold for 8,500 and will have a book value of 13,470. So you can see from that, we are going to be selling it for below book value. So we will have a loss. So that we know that if we have a loss, then we're going to have a tax saving, right? So it's actually going to benefit us. The equipment can be sold for 1,000 and its book value will be 350. So we're going to sell it for 1,000, value of 350. We're going to be making a profit of the difference, 650. We're going to pay tax on that profit, right? But so that's going to come in at the end. Okay. The fixed costs will be incurred on an annual basis in order to produce this new item, estimated at 66,000. And the variable costs are 40% of sales. So we've got a fixed cost base and we've got a variable cost base. So depreciation is allowed. Depreciation allowance is deducted from gross income in order to arrive at a company's taxable income. Okay, the following table details the depreciation and charges for the equipment. Okay, so this is setting out our depreciation for the building and depreciation for the equipment. Okay, we have a marginal tax rate of 35 and a cost of capital of 10%. So we've got quite a lot of information coming at us. So let's just take this step by step. Okay, so what they do is they effectively give you all of the workings and then they explain the workings. So let's just touch on a few of the points in the workings and then we'll flip to the explanations and then we'll flip back and forth. Okay, so in order to evaluate the project, the NPV and IRR need to be determined. In order to calculate the NPV and IRR, the cash flows for the life of the project obviously need to be determined, and we've got a discount rate of 10%, cost of capital of 10%. Okay, so there we have, I think, the unit price, 200, and unit sales of 110. So this is obviously going to come into our, so you can see that's going to filter into that. So as a start, we're going to have our investment outlay. We got the building, 15,000. We had equipment of 7,000, and we also had that increase in net working capital of 5,500. Okay, so we had total net investment at the start of a project of 27,500. Okay, everybody comfortable with that? Everybody feeling good? No problems. Okay, so then we're going to run through a little bit of our operating cash flows for the project's life. It's quite logical. So we've obviously got our sales, which they gave us a unit price and then a unit sales price. So 200 times by 110 unit sales gives us the sales value. We had our variable costs, which were 45% of sales, and we also had our annual fixed costs of 6,000. Then we had depreciation on the building and depreciation on the equipment. So I think these were calculated here and then here. So you can see that one there and that one there should be coming through down here. And then we get to an operating income before taxes of 4035. We're going to apply our 35%, our marginal tax rate, and we will come to an operating income after taxes of 2625. We need to be careful because this is not this is an accounting profit, and remember we are dealing with operating cash flow, so we need to add back the depreciation charge. So if we add back the depreciation, effectively the combination of these two, we would add back the 2065 and we would come to 4688. So that would be our annual cash flow. Okay, any questions with that? Everybody feeling good? Rob?
I have a question. On page 7, point number 2, operating cash flows over a budget slide. Right at the end of the term, it said TD.
Yes.
Tax rate and the depreciation charge. But there we just simply add back 2065, which is the depreciation charge.
Yeah. So if you work out the maths here, you would have taken out the depreciation here. So
sorry, I misinterpreted it to say 265 times the tax rate. Okay, I'll make a note.
say this one here.
Yes.
Yeah.
Yeah, TD next to each other. I thought they were multiplicated.
Yeah, well, so in that formula, they did tax times the actual depreciation rate, but the math should work out the same. Yeah, but they've kind of flipped the formula a little bit there. Yeah, yeah. Okay. Everybody cool with operating cash flows? So I can tell you that this is in every transaction that we look at, this is always a focus. So cash flows are always a major focus, trying to get to normalized cash flows, trying to essentially strip out once-off, non-recurring, almost building a base scenario of cash flows, then trying to build, an upside case. If you're trying to sell the business, then you have an upside case. Yeah, then we have our terminal cash flows. So our working capital would come back at us. We're going to talk about the net salvage value. So we're going to calculate that below. You guys will see in a minute. So we would come out at a total terminal cash flows value of 16,513. And then if we were to effectively align these cash flows alongside each other, we would see that we would have the outflow at the start. Then we would have our 4 years. This 16,513 is included in this 2104. Okay, so just so you know, the 16,513, and then obviously there must have been about, what is it, three and a bit on the previous page. I can't see it. 3591, yeah. Okay, so let's just run through a few of these points here, just to understand this a bit better. Okay, so we follow a 3-step process in order to calculate the necessary cash flows. So investment outlays, year 0. Secondly, we would determine the cash flows for each year. And in the final step, we determine the terminal cash flow. So we also add back to this figure an increase in net working capital in year 0. So we've spoken about in year 0, the initial cash outlay. It is the cost of the building and the equipment. So is everybody fine with that? 15 plus the 7 plus the net working capital of 55. We had a total capital outlay of 27, and we can see that up there. Then we focus a little bit on the operating cash flows, or the annual cash flows. The sales revenue is calculated by multiplying the selling price per unit multiplied by the number of units that are sold. And then obviously we can determine operating income. Yeah. So I I think a lot of that, I don't want to stand up here and just read it back to you, but I think, yeah, I think it makes sense. So once we have calculated the operating income after taxes, depreciation is then added back to this value in order to obtain the figure for the operating cash flow in that particular year. Okay, so terminal cash flows. So this goes to our points here. This number here, when I look through the notes, I don't think that is right. That should be 15. I don't think it impacts on the calcs, but that should be 15,000. The initial cost of the building was 15,000, not 7. So we had an initial cost of, for the building, 15, for the equipment 7. The sales value that we received was 8.5 for the building. We had a book value that was equal to 13,470. I think they told us that, but you can see how it's calculated when you take the initial cost less the depreciation charges. So you had a loss of 4,970. Because we had a loss, we will receive a tax benefit. The tax benefit is that minus 1,740. So typically we would say minus the tax that we would incur, but now we are minusing a minus, so it is actually a plus. So what we're going to be doing is we're going to be adding the 1,740 plus the value that we received in terms of the sale price. So we should be at 10,240. Does everybody see that? So the value that we received for the actual item plus the value of plus the tax saving that we would receive. In the case of the equipment, it's just the other way around. We had a sales price of 1,000. We had a book value of 350. That means we had a profit of 650. We incurred tax because now we've made a profit of 227. So if we add the 227, which is, sorry, we're not going to add the 227. We're going to subtract the 227 because that is an additional tax liability or tax payable that we have to make, right? Because we've made a profit, we have to pay tax on that liability or tax on that profit. So we're going to have to pay 227. So we take the 1,000 minus the 227. That should give us 773. Yeah. Okay. Let's see here. So the net salvage value for the building is the selling price minus the tax liability. I think they just go through the explanations here. So what we've just spoken about. So there you can see the 10,240. If we add the 10,240 plus the what was it on the previous page, the 773, we should get to this 11,013. And that 11,013 plus the net working capital, we got to a total terminal cash flow of 16,513. Then we took our 16,513 and we added the cash flow that was received in that year through the operations, and we got to a total value of 20,104. Okay, so then we were able to discount those cash flows, and you would have got to a net present value of 5,508. Or if you would have equated the cash outflows to the cash inflows, you would have got an IRR of 1732. Okay, any questions on that before we move on? Everybody feeling good? I think a lot of it is fairly logical. I think it's just a lot of practice. I think you've seen one or two of the questions that the CFA asks. Yeah. Okay, we're going to speak a little bit about replacement projects. So when we're talking about replacement projects, we're really talking about we already have an equipment or machine that's in place, and we're going to think about essentially taking that machine out, and we're going to think about putting a new machine in. So everything that we're going to be thinking about is the difference between the old and the new, right? So what is the incremental cash flow between those two? Okay, so So it's same principles as the expansion project, but just a little bit, just a few little nuances. Okay. So the replacement project is one where we consider whether or not an existing asset should be replaced with a new asset. Okay. So let's go through our same three steps: initial cash outlay, annual operating cash flows, and then a terminal cash flow. Okay, so the initial investment outlay. The initial investment would include the cash outlays or outflows to bring on the new machine. We would then have whether there's an increase in net working capital. Do we have to ramp up our inventory that is caused by the introduction of the new project? So what they also have here is, so that's exactly the same as our expansion project, but then what we also need to do is we need to take into account essentially the sale proceeds of the old asset. So this would effectively reduce our investment at the start, right? Because we're gonna get a little bit of money for the old asset, and in a similar fashion, when we looked at the terminal value, we're either going to have a profit or loss, and we're going to incur either taxes or we're going to have a tax saving. Okay, so does everybody see that? So new machine coming in, fixed costs, increase in net working capital, old machine going out, sale proceeds from the old machine, and potentially a tax saving or tax burden. Pardon? Yes, salvage value, sorry. Is that what you're referring to? Yeah. Okay. Okay, so here we're going to have incremental difference. So any change in sales, change in costs. So the incremental cash flows over the life of the project. Annual cash flows equal after tax plus depreciation. So I think we've been through that. We've got a change in cash flow. So we've got a change in sales minus a change in costs. Obviously, we're going to tax it, and we're going to have a change in our potential depreciation saving. Okay. So just effectively the difference between the old machine and having the new machine there. So what does that mean for our sales? What does it mean for our costs and any depreciation? And then lastly, we're going to have the terminal cash flows included increase in net working capital. So we're essentially going to say let's look at this. So sale proceeds resulting from the sale of the new item. We're going to get the working capital coming back at us. Let's just look at this. Sorry. Terminal year, cash proceeds resulting from the sale of the fixed capital on termination date. So that's fine. We're going to have the book value. So this is essentially going to be in any tax. So I think what they're saying here is that any difference, we need to record any additional sale value that we would attribute to the new machine, and potentially any change in profit that would be taxed from having the new machine versus having the old machine. Okay, so let's run through the example, and hopefully that starts to become clear. Okay, so a company has a piece of equipment it purchased 10 years ago for 20,000. The expected life of the equipment was 20 years, and it has been depreciated over the 20 years using the straight line. So depreciation value is 1,000, which is simply the 20,000 divided by 20 years. And you can see that the present book value of the equipment is 10,000. Okay, I think that makes sense. Quite simple so far. A new piece of equipment provides more functionality, can be purchased for 25,000. So that's obviously going to be our fixed cost outlay. Let's see here, the current market value of the existing equipment, to the extent we sold it, would be 5,000. So we would sell it for 5,000. We would have a book value of 10,000. We would have a potential loss, and for that we would have a tax saving. So the new equipment will reduce operating costs through savings in materials and labor. Operating costs will be reduced from 10,000 to 5,000 per annum. The reduction in costs will cause the company's tax profits to rise 5,000 per year. So we're going to obviously have a tax burden on that. Let's see here. So obviously our marginal tax, and we have an initial increase in working capital of 2,000. So that's obviously going to play into our our investment outlay. Okay. So let's. They have the cash flow spreadsheet is provided below for the project from conception. See operating cash flows. They use an accelerated depreciation. So you can see that they depreciate 33% in the first year, 45, 15, 7, and 0. Mm. I think you would receive a tax benefit, would you not? So let's run through the example. But my understanding is that you're going to sell the machine up front. If you sell the machine for a benefit or for profit, you would essentially incur tax on that profit at that point in time. Yep. Yeah. Yeah, so you're talking about a difference in tax when you pay the tax. Is that right? Okay. Yeah, so I think what you're getting into is a little bit more almost what happens in real life, and it's more practical because obviously you're going to have at one point in time you will make the investment, you will incur the tax liability, but the tax liability will only be settled at the end of the year. Is that what you're suggesting? Mm-hmm. I think you would treat them as a positive cash flow. Yeah. So I think for the purposes of the CFO, I think they would expect that everything happens at a single point in time. So they wouldn't necessarily. I agree with what you're saying that ultimately, in real life, when you actually dispose of the asset, you will have a tax benefit at that point or tax liability at that point in time, but you will not necessarily pay the tax at that point in time. So. Sure. Yeah. Yeah. I mean, you can think about. I mean, whether we're talking about a project or whether we're talking about a company, it's relatively the same thing. We're talking about an entity that essentially has cash flows coming in and cash flows going out. So, I don't necessarily think that whether it's a project or whether it's a company necessarily makes sense. But, I mean, ultimately, in real life, you essentially will incur tax liability at that point in time, but the tax liability won't be paid until exactly. Yeah. Okay, so let's run through the investment outlays. So we spoke about the equipment. We would have market value of the old equipment because we would be selling it for 5,000. We spoke about that there would be a tax saving. So for the purposes of this, we assume that happens at that specific point in time. So because remember we sold it for a loss. Let's see here. So we had an increase in net working capital of 2,000. And we had, so our total investment is 2250. Okay, everybody fine with that? Everybody kind of following? Okay, so here we get into annual operating cash flows and effectively what is the change in this cash flow. So let's see here. So we had a tax, so they suggested to us, I think that there would be a saving of 5,000 per year. So we can see that 5,000 per year, but then obviously now we're going to have an additional 5,000 of profit. We're going to be taxed on that, so we need to obviously include it net of the tax. Okay, so that's the 3.2. We're going to accelerate the depreciation, so the MAC percentage times by the price of the new equipment. So the new equipment was at 25, right? So the 25 times by the 33. Does that get us to the 8250? I assume so. Then we had depreciation on the old, so which was 1,000 per year. So we had a change in depreciation of 7,250. So obviously the 82 minus the 1. Okay, so we're going to have additional depreciation coming through. So we should see a tax saving, right? Tax saving from the depreciation of 2,538. So if we were to add the 3,250 and the 2,538, we should get to net operating cash flows of 5,788. Yep. So, and we do that for each year. Okay, so then we've got the terminal cash flows. So this one I just need to make sure because it can get a little bit tricky. We had estimated salvage value of the new equipment, so 1,000. Let's see here. So we had tax on salvage value, 35% was 350. We had the return of the working capital, which I think we can understand, and then the total terminal cash of 2,650. So the estimated salvage value of the new equipment, did they tell us that it would be 1,000? And they told us that it would be depreciated to 0, right? Because we were using that accelerated depreciation, which would depreciate it to 0 by the 5th year. Okay, so effectively our book value would have been 0, and we would have sold it for 1,000, so we would have incurred 35% tax on that. So we would have incurred tax of 350 on the sale price or the salvage value of 1,000. Okay. Okay, so we would have had a total terminal cash flows of 2,650. So then you can see that just by adding these up, the initial outlay, the annual cash flows, as well as the terminal cash flows, 2,650 and 2,900, we should get to total net cash flows. So you can see that the net present value, to the extent that you discounted this, the discount rate that they gave was 12%. Is that right? So that would equate to a net present value of minus 1,250. So naturally, you guys are going to see this and you're going to say, like, absolutely not. We're not undertaking this project. It will destroy shareholder value. And consistent with that, our IRR is less than 10%, right? So that is below our cost of capital, 12. Do you have a question? Correct. Yeah. So, yeah, I would assume that it's been. Yeah. Yeah. Well, I tend to think that it would be. Zero. It didn't exist. Yeah. At the end. Yeah. At the terminal value. Yeah, so I mean, just thinking practically, we would essentially dispose of the old equipment at the start. So we wouldn't have the old equipment at the end. So I looked at that formula and I wasn't 100% sure why they referenced the old equipment there, because it would effectively be 0 in all cases. Yeah. Pardon? Yeah, so this is the replacement, right? So old machine out, new machine in, we just look at the differences. Okay, so let's just, I don't necessarily think we should run through each one of these items because I think they get into quite a long explanation. Yeah. Okay, so there's quite a detailed discussion there. Is everybody okay that we essentially move on? Okay. If you have any questions, just please come up to me at the break, and then we can discuss. Okay, let's keep on. So I'd like to go till about 9:30, and then we take a break for about 10:30. Sorry, 7:30, and then we'll take a break for a little bit. Okay. Don't listen to what I'm saying. Just focus on the notes. Okay. Okay, so just a few points about inflation. So I thought that this was particularly relevant. So your date for Saturday night, inflation, and how it impacts on the cash flows, right? So I know that you guys will probably be at the library the whole of Saturday, so that's great. Okay, so nominal versus real cash flows. So obviously, if we have nominal cash flows, which means that we include inflation in our cash flows, we're going to have higher cash flows, but then we also need to include inflation within our cost of capital, right? So we need to make sure that the cash flows and the discount rate reflect one another, right? So nominal cash flows discounted at nominal rate, real cash flows discounted at the real rate. Have you guys, who here has done discounted cash flows? I'm sure a few of you guys have done. So, I mean, what do you guys use? Real or nominal? Anybody? Well, I mean, so certain businesses will use real and certain businesses will use nominal, right? So I remember I was chatting to some guy that was involved in the mining space, and because they dealt a lot in dollars and obviously the commodities were priced in dollars, so they did everything in real cash flows. So they focused a lot on discounting at a real discount rate. So any discount rate that stripped out inflation. Every discount model that I've been involved in is actually just focused on nominal. So we include, when we talk about our cost of capital or nominal discount rate, we build that up inclusive of inflation, right? Okay, so the net present value involves finding the present value of the future cash flows discounted at the cost of capital. So I think we can all understand that. So a high value for K being the discount rate, the project will yield a lower net present value, right? Because it's inversely related, right? So the higher your discount rate, the lower your net present value. So if inflation is expected, is not built into the forecast, so your cash flows, the forecasted cash flows are lower than is accurate, because inflation does inevitably come through. You're going to be discounting at a rate that includes inflation, and because of that, your net present value will be lower, right? Because your cash flows do not include inflation. Okay, so does everybody make sense of that? So ultimately, your cash flows are lower. You're going to be discounting at a higher rate. Because you discount high, remember it's inversely related. It's like happiness and passing the CFA, inversely related, right? So the more miserable you are, the higher the likelihood to pass. So same with NPV, higher inflation discount rate, lower NPV. Okay. The depreciation expense is affected by inflation. Remember, depreciation is based on historic, right? So historic price of the asset. So it was quite interesting. We looked at a business, about 2 years ago, that does a lot of equipment and forklift equipment, leasing of machinery and things like that. And it was amazing to see how they had to invest in new capital expenditure each year. And they obviously had a depreciation charge that was coming off each year. And the depreciation charge was so small relative to the capex that they were having to put in. And you would think, geez, you must be growing your fleet of forklifts. Maybe you're adding a lot more forklifts. And they said, actually not. It's just that the depreciation is based on the historic, and because of that, it was at lower value. Whereas obviously all capex now includes inflation. So every 5 years we need to churn our fleet of forklifts. And because of that, inflation had an enormous impact on the depreciation expense. And obviously, I'm sure you guys already know this, the value of a bondholder erodes with higher inflation, right? So if you, every time you hear that inflation is going to be high, all of your bond prices drop, right? So inflation eats away at the returns to bondholders. Inflation is obviously going to impact on income and expenses differently, okay? So you need to take that into account whenever you're modeling out your cash flows. Any questions, any thoughts? All good? Okay, so let's talk about two things. So to the extent we have to choose between two projects, but specifically those projects that have unequal lives, we're going to talk about using a least common multiple lives approach, and then we're going to talk about what's called a equivalent annual annuity approach. Okay, so and then all we're going to do through that is we're going to be able to correctly identify if one project runs for 3 years, another project runs for 6 years. How do we essentially make sure that we're comparing apples with apples? Okay. So we need to think about two mutually exclusive projects. We can only do one or the other. We cannot do both. Two methods for dealing with mutually exclusive projects that span different lives. So you're going to see here project 1 goes for 6 years, project 2 goes for 3 years. So what we need to do is in order to appropriately calculate the NPV and IRR values, we need to match the lives. So you can see in project 1, NPV 6402, IRR of 16. Project 2, lower NPV, right, than project 1. So you would instinctively think I need to go for project 1. But the IRRs actually conflict, right? So here you can see higher IRR, 21 versus an IRR of 16. So what we need to do is we need to make sure that the lives reflect or the same. So let's just go through the workings here. So project 2 will terminate in year 3. Project 1 runs for 6 years. So there would be an opportunity to make a further 3-year investment when project 2 terminates. And so they refer to that as project 3. So project 3 may yield the same cash flows as obviously as project 2. Yeah. So in order to make a proper comparison, we need to extend project 2 by an additional 3 years, such that it will have the same lifespan. Okay, so I think that's the key message. Okay, so if we just extend project 2 for a further 3 years, at the end of year 3, we can invest the money for an identical 3-year period. So we would have another outflow of 2,500. So from the revised timeline, we would get an NPV of 7,579, which I think that was higher than project 1. So this method of extending the timeline is called the least common multiple lives approach. Yeah, typically, I mean, it depends in the context. So, yeah, if you're thinking about a lot of, because I mean, capital budgeting, all we're talking about is just cash going out, cash coming in, right? So, and that's when I say that corporate finance is life. I mean, everything is based on cash flows coming in and cash flows going out, right? Value out and value coming in. So if you look at things like your equities, if you look at things like your fixed income, it's all just the same thing of cash going out. So whenever you have a bond price, the bond price is really just the present value of those future cash flows for the bond, right? So, and it's the same with equities. So in our field, we are valuing companies. Companies are assumed to have a life into perpetuity. So typically you have cash outflow or cash outlay, annual cash flows. At the end of 5 years, you will effectively calculate a terminal value. So it is unlikely that, unless you are doing something that does project finance or something like that, whereby you may have two projects that sit alongside each other. It's more on things like where you're considering two investments. So we will weigh up, 2 or 3 different companies, and so we will project the cash flows out for that specific company for 5 years. At the end of 5 years, we'll have a terminal value that we'll calculate. But it's an equity formula, yeah. So pardon? Yeah, you're gonna match up the lives. So you're gonna match up the lives. So yeah, but you got to be careful with RR. So RR as well, if you have unconventional cash flows, so you've got cash going out, cash coming in, cash going out, cash coming in, then you're going to get multiple RRs, right? So it doesn't necessarily work. And then sometimes you can also have differences, like say you have one very large project. So I have an opportunity to invest 1 million, and then I have an opportunity to invest 10 Rand. The 10 Rand may have an IRR of 50%, but frankly, I'm only going to go from 10 to 15. But if I have something that's going to be where I can invest 1 million and I can make an IRR of like say 25%, maybe better to invest a much larger amount, and actually, even though the IRR is significant. So the size of the project matters as well. Because really, I mean, NPV is the actual cash value to the shareholders. That's cash value created for the shareholders. So yeah, so IRRs, I mean, certainly it's way up there. Yeah, but net present value is the best. Yeah. The other thing with net present value is that I assume you guys would have looked at this in fixed income. I think when you talk about a yield to maturity, it assumes that the cash flows are reinvested at the yield to maturity. Is that right? Yeah. Whereas the net present value, so your yield to maturity and your IRR are the same thing, right? So, but a net present value, your cash flows are reinvested at your cost of capital, not at the IRR or the yield to maturity. So you can also get conflicts there. Okay, so let's see. So we focus on the highest NPV that is accepted. Project 2 was more attractive. So what we need to do is we need to find the lowest common denominator for the 2 durations. Yeah. Okay. Equivalent annuity approach. So essentially calculates the annual payments that a project would provide if it were an annuity. So we're going to calculate what would if this was an annuity, so like cash outflow and then cash inflow, inflow, what would those annuity payments be? So annual payments that a project would provide if it were an annuity. I'm comparing projects of unequal lives. So for each project, NPV using the stipulated life, we would calculate the NPV, and then we would calculate the annuity. So let's see here. So the NPV for project 2 was 4,428. If we were to let's see here. So put that into our calculator. I assume you guys know how to use the cash flow function on your calculator. I'm sure by now level 1 would have taught you that you're probably going to print off that calculator manual. You're probably going to keep it next to your bed. It's your best friend in the exam. So if you were to use the cash flow functions, you would have seen that it would have resulted in an annual payment of 1843, right? So it would have been 1843, 1843, and then 1843. And then we would do effectively the same for project 1. And we should come out to project 1 was slightly less, yeah, 1362. So the project with the highest equivalent annual annuity will have the highest NPV. So naturally we would choose project 2. So let's go here, that will lead to the same result. Any questions? Okay. Okay. As this method. Okay. 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 Let's continue for the last 10 minutes. A lot of this is just theory around capital rationing, and then scenario analysis, sensitivity analysis, and then we're going to talk a little bit about just quickly Monte Carlo. So capital rationing. So to the extent you are presented with multiple projects, you are going to need to ration your capital. So you need to place a limit on the size of its capital budget. So typically capital is considered to be a resource. You have limited resources or you have limited capital. Capital rationing is the process whereby the fixed amount of capital is allocated across the available set of projects. So you can either have what's called hard capital rationing or soft capital rationing. The only difference is that under soft capital rationing, to the extent that the project makes sense, then you can typically go back maybe to your investors or something like that and say, look, I think that this project is very attractive. I think we should do it. So they may increase your budget. Yeah. So for example, in the little case down here, they say that Yaku is an investment manager. He has a maximum capital budget of 100. So the maximum that he can outlay is 100. So he needs to split that over the next 5 projects. So what he needs to do is he needs to allocate it over these projects in such a way that he maximizes the NPV, right? So naturally, most people would say, look, I want to go to project A because it's going to give me the highest NPV, but at the same time, it's also going to absorb the highest amount of capital. So if you were to, best option here, they say, would be to select project D, B, D, and E, because if you were to add up the NPVs across those, it would A, give you a chance to allocate the full amount in terms of the 100, and then it would give you the highest NPV. That NPV would equate to 50 million. Okay. So here they just do a little bit of an explanation. It will result in project A not being selected. Project A, then the only available projects still to be selected would be project D and E. So, okay. Just quickly, so when we talk about, we always do this when we develop cash flow models. We talk about sensitivities and we talk about different scenarios. We typically have the base, and then maybe a downside scenario, and then an upside scenario. And then to the extent you want to get a little bit more sophisticated, you can buy computer programs that will help you with what's called Monte Carlo simulation, where the computer actually assigns probabilities across different scenarios or different variables that contribute to a scenario. Who here has used Monte Carlo? Anybody? Okay. Well, where have you used Monte Carlo? In when, sorry? Okay. Just explain that a little bit. Okay. Okay. Yeah, so underlying variables. Okay. I've only seen the output for Monte Carlo. I've never actually been involved in actually undertaking the process. So, but my understanding gives you a bit of a distribution curve. Is that right? Okay. Yeah. Yeah. It's impossible to explain to people. I mean, I'm trying to explain it here, and it's just impossible, you know. Okay, so let's talk a little bit about sensitivity scenario in Monte Carlo. Okay, so sensitivity analysis, we are just going to assign across different variables. We're going to assign things like what happens if sales move up by 10% or move down by 10%. You know, what does that mean for our net present value? Okay. We can also do, to the extent, variable cost per unit. So, for example, in our baby business, if any of you happen to be going along Bowling Road, one of our baby businesses is there. We look at things like fees, school fees, and we look at things like number of children in the schools. So those are 2 key value drivers for us. So we look at, to the extent that the enrollment drops off for some reason, or to the extent that we increase school fees by a certain range, or we give discounts by a certain range. So those are key variable drivers. Obviously, things like cost of capital is always a focus. So to the extent, when we spoke about cost of capital, level 1, we talked a lot about using debt. You know, debt is typically cheaper than equity. Because of that, we should reduce or lower our weighted average cost of capital. I think on the next page, they just have various graphs. So you can see here, just mapping out the NPV based on changes in sales, changes in variable cost per unit, and then changes in the cost of capital. Okay. So you can see here, the steeper the slope, the more sensitive to NPV. and we've got scenario analysis. Yeah, as I mentioned, typically you have different scenarios. So you can say just a combination of things. So change certain key variables, and how are these likely to be reflected. So let's see. So typically you have things like a base case, a worst case, and a best case scenario, right? Okay, everybody fine with that, right? I think it's fairly logical. You know, when you do your cash flows, you may say, I'm going to have, you know, best case, hit all my sales targets, and I have something else that happens. My costs are kept in check, and because of that, my NPV would look particularly good. And then lastly, we have the Monte Carlo simulation. So there's Monte Carlo simulation. So what you do is, my understanding of this is that you have several variables. The computer will assign probabilities across the different variables. And then the computer runs multiple scenarios, right? Like 1,000 scenarios. Yeah.
So we did cover this in something else when we did option valuation.
Have you seen it? Okay, great. Well, then I don't have to explain it. Great. So
basically, you just take a bunch of scenarios and take average of those.
yeah, and then my understanding is you get to this distribution curve, and you can say, well, you know, there is a 90% chance that it's going to be between like a lower bound and upper bound threshold. Okay. Okay. Why don't we take a break there? How long do you guys need? 5 minutes? Let's take a break for 20 minutes. If you can please come back at 7:50, please. 7:50, we'll get cracking.